As of this moment in pre-market trading on Friday, October 31st, 2025, SoFi stock is trading at $29.59, showing a bit of strength, up about 1.9%. This move, however, is a very small attempt to recover from what was a brutal session for shareholders yesterday. The market is closed for regular trading, but yesterday's session saw SoFi Technologies close at $29.03, a nasty drop of over 6% on the day. That 6% drop is what we need to focus on because it defies the entire narrative that has been building around this company for the last week. The immediate expectation, given what we just learned, is that this stock should be flying. SoFi just reported its third quarter 2025 earnings a couple of days ago, and by every conventional metric, they absolutely crushed it. We're talking record net revenue of $962 million, a 38% increase year over year. We're talking record net income of $139 million, a staggering 129% jump. They beat analyst estimates on both the top and bottom lines. They raised their guidance for the full year. This was, by all accounts, a beat and raise quarter of the highest order. And yet, here we are. After an initial pop on the earnings news, the stock has been hammered, falling from a high of over $32 down to this $29 level. This is the expectation versus reality disconnect that defines high-growth stocks. The expectation was that consistent, record-breaking, gap-profitable growth would finally silence the bears. The reality is that the market took this incredible news, chewed it up, and responded with a massive sell-the-news event. This tells us something much deeper is at play than just a simple earnings report. It tells us that despite SoFi's transformation, the market is still deeply conflicted about what this company actually is. Is it a stable, boring bank, or is it a high-risk, high-growth technology platform? Yesterday's 6% drop in the face of stellar news tells us that right now, the market is voting for high risk. Let's get on common ground here. The bull case for SoFi is frankly intoxicating. It's the one-stop-shop dream. It's the idea of a financial super app that captures a customer, usually a high earner, and then cross-sells them everything. You come in for the SoFi Invest platform to do some online investing, maybe buy some SoFi stocks or SoFi ETFs. You see, they also have a SoFi robo-advisor, which competes directly with things like Schwab Intelligent Portfolios. Then you see their high-yield checking and savings account, so you move your direct deposit. Now that they have your financial data, they can offer you a personal loan, a student loan refinance, or a mortgage. This is the financial flywheel CEO Anthony Noto talks about constantly. It's what's supposed to separate them from the competition. You don't go to Fidelity for a personal loan. The Robinhood app is fantastic for Robinhood stock trading and Robinhood fractional shares, but it's not a full-service bank. Interactive Brokers is a powerhouse for professionals who need the best Interactive Brokers trading platform, but it's not trying to be your primary checking account. SoFi is trying to be all of them, a single destination for self-investing and all other financial needs. And the earnings report seemed to prove this model is working. They added a record 905,000 new members in the quarter, bringing their total to 12.6 million. This isn't just a fintech app, it's becoming a mainstream financial institution. The most important part of that earnings report, the part the bulls are clinging to, was the segment breakdown. The lending segment, their old bread and butter, was strong. But the financial services segment, the part that includes SoFi Invest, SoFi Money, and their credit card, saw revenue grow by an incredible 76% year over year. This is the fee-based, high-margin, sticky revenue that is supposed to de-risk the company from its reliance on lending. This is what you want to see. This shift is critical. It proves they aren't just a loan company, they are a diversified financial technology platform. This is the story. So why the 6% crash yesterday? Why the sell-off? The reality is that this stock had an enormous run-up into this earnings report. This stock has climbed roughly 88% year-to-date. In the past month alone, it rallied from around $25 over $32. the trading volume tells the story. On earnings day, SoFi traded a mind-blowing 183 million shares. The next day, 95 million shares. Yesterday, another 70 million shares. This is not retail investors taking a little profit. This is institutional capital, the smart money, hitting the sell button with extreme prejudice. They are treating this stock not as a long-term investment, but as a trading vehicle. This is the behavior you see in a Tesla stock or an Nvidia stock after a massive run where the valuation has gotten ahead of itself. Analysts are even piling on, with Truist, Citi, and Goldman Sachs all raising their price targets, but the market is ignoring them. It seems the big funds that bought in the low 20s saw $32 as their exit, and the stellar earnings report was the perfect liquidity event to let them unload their positions onto eager retail investors. Now let's take a quick step back for anyone new to the story and talk about what SoFi Technologies actually does. The company is broken into three main parts. First, there's lending. This is their original business: student loan refinancing, personal loans, and home loans. This segment is their cash cow, but it's also the most sensitive to the macroeconomic environment, specifically interest rates and unemployment. Second, there's the financial services segment. This is the super app we discussed. It includes SoFi Money, banking, SoFi Credit Card, and SoFi Invest. This SoFi trading platform is where they are competing head-to-head with Robinhood, Fidelity, and other investing sites. This segment is all about member growth and cross-selling. And this is the part many investors overlook, is the technology platform. This is their B2B, business-to-business segment, which includes Galileo and Technesis. SoFi provides the back-end technology, the digital plumbing that powers other fintechs and financial institutions. This is a high-margin, software-as-a-service business that provides a stable, recurring revenue stream. The bull case is that these three segments create a symbiotic relationship, the flywheel, that no one else can match. A Fidelity wealth management client is unlikely to use a Fidelity brokerage account that's powered by a competitor, but SoFi can power its rivals while also building its own consumer brand. This brings us to the future outlook, and the tension is palpable. The expectation is that SoFi, now consistently GAAP profitable for 8 consecutive quarters, has proven its model. The company raised its 2025 guidance. The financial services segment is growing exponentially. The technology platform is a solid backbone. From this perspective, the recent 10% pullback from its highs is a massive buying opportunity. The reality is that SoFi is still a prisoner of the macro environment. Its valuation, at over 50 times forward earnings, is extremely high. It's not valued like a bank, it's valued like a high-growth tech stock. This means it is highly sensitive to interest rate fluctuations and, more importantly, to the health of the consumer. The core of its profit still comes from its lending segment. If the economy weakens, if unemployment ticks up, loan defaults will rise. That is the bear case. That is the fear that allowed institutions to sell 70 million shares yesterday, even after a record-breaking earnings report. They are betting that the macro storm clouds are more important than SoFi's individual performance. The competition is also not standing still. The world of online investment is brutal. Fidelity Investments is a behemoth with trillions in assets, offering a robust Fidelity trading platform and a wide array of Fidelity mutual funds and ETFs. They also offer Fidelity IRAs and have a powerful Fidelity mobile app. They are not the slow-moving giant they used to be. Then you have Robinhood, which, despite its past controversies, continues to define the SoFi active investing space for a younger generation, especially with its moves into Robinhood Crypto and Robinhood Cash Management. Even platforms like Interactive Brokers, known for low Interactive Brokers fees and a platform for serious traders, are pushing into more mainstream investment help services. SoFi's super app model is a brilliant strategy, but it's fighting a war on all fronts against the individual brokerage accounts of the legacy firms and the sleek apps of the new guard. So, here's the central question for investors, and I want you to comment below with your answer. What is the single biggest headwind for SoFi stock right now? Is it the macroeconomic fear of a recession hitting their loan book, or is it the intense competition from the likes of Fidelity and Robinhood? As we wrap up, we're left with this stark contrast. The expectation, fueled by a flawless Q3 earnings report, was that SoFi had finally graduated. It was no longer just a high-growth story stock. It was a diversified, profitable financial powerhouse. The numbers proved it. The reality, delivered by the market's brutal 6% rejection of that news yesterday, is that SoFi is very much a show-me story. It's a stock caught in a tug of war. On one side, you have the fundamentals of a bank, which are now solid. On the other, you have the valuation of a tech stock, which is volatile and unforgiving. The market is telling us that until it sees how SoFi's loan book performs